Hi everyone, welcome back to the channel. In this video, I want to talk about the headlines that's been going on in the financial news, talking about stimulus and how that affects the stock market. Because over the past week, there's been so much talk about if we're going to get another stimulus deal or not, and we are seeing the stock market have some pretty big swings based on that news. So in this video, we're going to talk about that, and I want to clear up some misconceptions on how stimulus actually affects the stock market and why the stock market seems to be so dependent on this stimulus. So like I said, these headlines are all over the place. Just a quick Google search, you get all of these headlines. Right, so these headlines are all over the place, where you see Wall Street Journal, Dow, S&P 500 rise on stimulus hopes, gridlock over new stimulus measures is the biggest catalyst for market volatility, Dow swings 600 points after Trump rejects stimulus plan, then stocks rise as Trump appears to soften stance on stimulus. So you get the point, right? The market is having these big swings and reactions to the probability of us seeing another stimulus deal in the near future. Now, what all these headlines are telling me is that the stock market is incredibly dependent on stimulus. And so the truth is that the stock market really shouldn't care that much about stimulus. Yes, obviously it's supposed to help consumers and that will help them, buy products that will help companies in the stock market. But overall, what everyone's talking about in the news is that the stock market is the thing that's going to get the biggest benefit from a stimulus package. And so what this is showing me is that the stock market has been propped up by all the stimulus money, that really now the stock market needs stimulus because that's the only thing that's been fueling this rally from the March lows up until now. All right, in my opinion, the only reason we recovered so fast to make all-time highs is because of all the new stimulus we've been getting. And right now, it's almost like the stock market is addicted to stimulus, where on talks of a new stimulus deal, you see the stock market jump up. And in cases where politicians are talking about stimulus deals being off the table, the stock market instantly crashes. So now I'm going to show you some other factors and why I think ultimately, whether we get more stimulus or not, the impact on stocks in the long term is not very good. So I'll pull up this chart now, and here is a very illuminating chart. What this chart is showing is the M2 money supply. So that's all the money in circulation versus the velocity of money. And what I want you to notice is that this period from around 1960 to 1995, these two things are relatively correlated. But since then, we've seen a huge divergence from since 1995, we've seen the M2 money supply shoot up while money velocity since 1995 has really done nothing but go down. And for anyone that doesn't know, velocity of money is just the rate at which money is in circulation in the economy. When more people are spending money on things, velocity of money goes up. And how that factors into the economy is high money velocity is usually associated with a healthy, expanding economy. Obviously, an economy is thriving when there's people spending money. And low money velocity is associated with recessions and contractions. And that makes sense, right? When people aren't spending money, the economy isn't going to be as robust. So since 1995, we've seen this velocity of money going down. And so what this shows me is that the economy has really been becoming less and less robust ever since the 1990s. Meanwhile, the money supply has just spiked up, and that is really what's fueling the stock market right now and keeping the economy afloat. Now, here's a chart on why this impacts the stock market. This is a chart of the M2 money supply versus the S&P 500. And as you can see, it is a relatively correlated chart where people always say, in the long run, stock market always goes up. But guess what? So does the money supply. Money supply has been very constantly increasing for the past 100 years. And an increasing money supply isn't that huge of a problem. It's to be expected. But the rate at which the money supply is increasing is something to keep an eye on. And as you all know, with the unprecedented amount of stimulus over the past year, the money supply has absolutely spiked up. So we see that, this rate of change with the money supply from 1995 to around 2008 was pretty constant. Then we saw it increase a little bit as the Federal Reserve put in a bunch of stimulus to combat the great financial crisis in 2008. And then in 2020, ever since March, we had the huge economic shutdown, and the Fed just decided to go all out on the printing money and inflating the money supply. And so what we saw was right at this point where the Fed started increasing the money supply, and that is just the point where we saw a historic recovery in the stock market. At the same time, we see a record amount of money being created. So is that a coincidence? That's something you're going to have to decide for yourself. Now, the person who's in charge of this money supply, who is currently Jerome Powell, chairman of the Federal Reserve, gave a talk just a few days ago giving his remarks on the economy, and he had a question and answer session. And these Q&As are usually the most valuable part of when the Fed chairman speaks, because this is where he's going to be off script, right? Most of his prepared remarks, he's practiced, he knows what he's going to say, but when he gets questions from people that he hasn't prepared for, that's when you really get a sense of the position of Jerome Powell and the entire Fed. And so we got one interesting question from this reporter. You've shown us how inflation has flattened over the past decades, and that has allowed you to be in a position where you say, we want to target more inflation. And then, she asked, is this a risk you should be more cognizant of? Sort of be careful what you wish for, where you're hoping for all this inflation to come up. If we do get a scenario where the inflation is actually more than you anticipate, how are you going to plan to scale that back? And is that a risk that you are considering? And while Jerome Powell responds to this, he never really answers the question. All he really says in his response is that we would be lucky to have more inflation because we've had, such low inflation for such a long time that we really need to embrace more inflation. He says that right here. These have been persistent forces. Now disinflation, declining inflation has been a persistent factor for some time, and that we're still seeing a downward pressure. And so he thinks it's appropriate for central banks to target inflation and really try to drive inflation as high as possible. So the Fed and Jerome Powell want more inflation, and they don't really see, out of control inflation as a risk. But this last chart I'm going to show you drives home why I think there's going to be higher inflation in the near future, and that is going to create a bunch of problems for the economy and the stock market. This is a chart comparing money supply versus inflation. And this is a chart going back all the way to 1870. So we have a lot of data here, 150 years. And what you can see is, even though it's not a perfect match by any means, the rate of change of money supply and the rate of change of inflation are relatively correlated. There is a correlation there. When you see money supply growth go up, you usually see inflation start to spike, and then you see that again when money supply is shrinking. We're usually in periods of deflation. And when you look at this chart, whenever you see a big gap between the change in money supply and where inflation is, we usually see that begin to reverse. Where, right here, there's a big gap, inflation and money supply, and what you see over the next 10 to 20 years, inflation really runs up. And this was the 1970s when there was inflation out of control and we had to raise interest rates to combat that. And if you look at right now, what happened with the money supply, this is the fastest increase of the money supply over the past 150 years. Meanwhile, we've seen inflation not really budge, and the Federal Reserve saying we don't really see out of control inflation as a risk. We just want to create as much inflation as possible, right? And so when I look at this chart and I see, how much the money supply has increased versus where inflation is right now, I think there's a very high chance we're going to see inflation, and maybe that won't happen, next month or next year. These things usually take time to play out, but over the next 10 years, I am expecting a higher amount of inflation, especially since this increase in money supply isn't likely to be over yet. We saw an unprecedented amount back in March, but now new stimulus is likely to be coming, so I'm expecting this growth rate of money supply to stay abnormally high for an extended period of time, and this is what I think will bring about higher inflation. And then there's always that risk of what if inflation gets out of control, and at that point, the Federal Reserve doesn't really have many options. The thing that they'll probably have to resort to, and what worked back in the 70s and 80s, was raising interest rates all the way up to almost 20%, and that finally brought inflation under control. But as you probably know, with interest rates being at around zero right now, any sort of increase in interest rates would be disastrous for the economy and likely the entire stock market. So that is just what I wanted to touch on in this video. All the narrative out there right now is that the stock market needs stimulus, and while I would argue that is true in the short run, to keep this recovery going, we need more money to be pumped into the stock market. In the long term, I think this will have adverse effects on the stock market, especially if we see inflation start to tick up. So if you got value out of this video, hit the like button to help YouTube push out this video to more viewers. Subscribe to the channel if you haven't already, and that's it for now, so I'll see you on the next video.